Let me tell you about something I have been watching very closely. A crack in the financial system. Not a collapse, not a crisis yet, but a crack, a weakness that is growing. A vulnerability that could spread very quickly under the right conditions. I have seen this pattern before. I saw it in 2007 before the financial crisis. I saw it in the late 1990s before the long-term capital management collapse. I see it now. And what concerns me is how fast this crack could spread if it gets triggered. I am Ray Dalio. I have spent over 50 years studying markets, building Bridgewater Associates, and developing frameworks for understanding how financial systems break. And right now, I am seeing stress building in a part of the financial system that most people are not paying attention to, a part that, if it breaks, could cascade through the entire system very quickly. Let me explain what I am seeing, where the crack is, and why it could spread so fast. The crack I am most concerned about is in commercial real estate, specifically office buildings and retail properties. This is not just about empty buildings. This is about $1 trillion plus asset class that is over-leveraged, overvalued, and sitting on the balance sheets of thousands of banks and investors, and the cracks are starting to show. Let me explain the mechanics of why this matters so much. Commercial real estate operates on a simple model. An investor or developer buys or builds a property. They finance it with a mortgage, typically 60 to 75% loan to value. They lease the space to tenants. The rent pays the mortgage and operating expenses. Hopefully, there is positive cash flow left over. When the mortgage matures, usually 5 to 10 years, they refinance at current rates. This model worked beautifully for decades when interest rates were declining or stable at low levels. You could borrow at 3%, refinance at 2.5%, and the property kept generating cash flow. Property values kept rising because low rates meant investors would pay higher prices for the same rent stream. Everyone was happy. But the model breaks when interest rates spike. And that is exactly what happened. The Federal Reserve raised rates from near zero in 2021 to over 5% by 2023, the fastest rate increase in 40 years. A commercial property that was financed at 3% now needs to refinance at 7%. The mortgage payment more than doubles. Suddenly, the rent does not cover the mortgage. The property has negative cash flow. And property values have fallen because higher rates mean lower valuations. Now add another problem. Occupancy has collapsed in office buildings. The shift to remote and hybrid work during COVID permanently changed how people work. Many office buildings now sit 30 to 50% empty. Companies are reducing their office space. They are not renewing leases or they are renegotiating for much lower rent. This means less rental income at the exact time that mortgage costs are spiking. The math is brutal. Imagine a building that was bought for $100 million with a $70 million mortgage at 3%. The annual mortgage payment was about $3.7 million. The building generated $5 million in rent, leaving about $1 million in net operating income after the mortgage. Life was good. But now the mortgage is maturing. To refinance $70 million at 7%, the payment becomes almost $5 million per year. But rent has fallen to $4 million because tenants left and remaining tenants negotiated lower rates. Now the property is losing $1 million per year. What does the owner do? They have a few options. None good. They can put more money into the property to cover the negative cash flow, but that is throwing good money after bad. They can try to negotiate with the lender, maybe extend the loan, maybe get temporary relief, but lenders are getting nervous and less willing to extend. Or they can walk away, hand the keys to the lender, and let the property go into foreclosure. This is happening increasingly. Now here is where it gets systemic. Who are the lenders on these commercial properties? Regional banks. Small and medium-sized banks across the country have massive exposure to commercial real estate. For many of these banks, commercial real estate loans represent 30 to 50% of their loan portfolio. These are not diversified money center banks. These are community banks, regional banks, that specialize in local real estate lending. When commercial properties start defaulting, when borrowers hand back the keys, the banks take losses. They foreclose on the property and try to sell it. But who wants to buy an office building that is half empty with rents falling? The bank is forced to sell at a huge loss. Maybe they get $50 million for a property that had a $70 million mortgage. That is a $20 million loss. Multiply this across dozens or hundreds of properties and you have a solvency crisis at the bank. We saw the beginning of this last year in 2023 with Silicon Valley Bank, Signature Bank, and First Republic. Yes, those failures were primarily about unrealized losses on bond portfolios and deposit flight. But commercial real estate problems were lurking in the background, and those problems are getting worse, not better. As of late 2024, we are seeing increasing signs of stress. Delinquency rates on commercial real estate loans are rising. They have gone from under 2% to over 6% in some categories. Office property values have fallen 20 to 30% in many markets. Transaction volumes have collapsed because buyers and sellers cannot agree on prices. Banks are tightening lending standards, making it even harder for property owners to refinance. This is the crack. And the reason it could spread fast is because of interconnections in the financial system. Let me walk you through how a commercial real estate crisis could cascade. Stage 1 is property defaults and bank losses. This is happening now. Individual properties are going bad. Banks are taking losses. So far, it is manageable. Banks have capital buffers. Regulators are monitoring. The losses are dispersed across many institutions. But the situation is getting worse, not better. Stage 2 is bank failures. If commercial real estate losses accelerate, some banks will fail. Not the biggest banks, they are more diversified, but regional banks with heavy commercial real estate exposure, we could see 5, 10, 20 bank failures in a year. Each failure requires FDIC intervention, costs money, creates headlines, and spooks depositors at other banks. Stage 3 is deposit flight and credit crunch. When banks start failing, depositors at similar banks get nervous. They withdraw deposits, even from healthy banks, just to be safe. This was the dynamic in March 2023. Social media and instant information mean bank runs happen in hours, not days. Banks that lose deposits must shrink their balance sheets. They stop making new loans. They call in existing loans where possible. Credit availability dries up. Stage 4 is contagion to other asset classes. The credit crunch spreads beyond commercial real estate. Small businesses cannot get loans. Consumers cannot get credit. Companies cannot refinance debt. Asset prices fall across the board because no one can get financing to buy anything. Stocks fall. Residential real estate slows. Private equity struggles. Everything interconnects. Stage 5 is intervention and consequences. The Federal Reserve and Treasury step in to prevent systemic collapse. They provide emergency lending to banks. They might guarantee deposits beyond FDIC limits like they did in 2023. They might even buy troubled assets like they did in 2008. This stabilizes the immediate crisis but creates other problems. Moral hazard, inflation from money printing, larger government debt. The crisis gets contained, but the underlying issues remain. This 5-stage cascade could unfold over 6 to 18 months. It might start slowly, a few bank failures here and there, but as confidence erodes, it accelerates. Stages 1 and 2 might take 6 months. Stages 3, 4, and 5 could happen in weeks once panic sets in. This is what I mean by spreading fast. The crack widens slowly at first, then rapidly. Now let me talk about other cracks I am watching that could interact with the commercial real estate problem to make things worse. Because the financial system is interconnected, multiple cracks in different places can converge into a systemic event. The second crack is in private equity and private credit. Private equity has grown enormously over the past 15 years. Trillions of dollars have flowed into private equity funds that buy companies, load them with debt, and try to improve operations and sell for a profit. Private credit, non-bank lending to companies has also exploded. Over $1.5 trillion in private credit markets. Both industries thrived in the low-rate environment. Private equity could borrow cheaply to buy companies. Private credit could offer attractive yields to investors while taking reasonable risk. But higher rates have stressed both models. Private equity portfolio companies are struggling with higher debt costs. Many were bought with leverage at low rates. Now that debt needs to be refinanced at much higher rates. Some companies cannot handle the increased cost and are defaulting. Private credit lenders are facing rising defaults. They lent to companies that could service debt at 5% but cannot at 10%. The private credit market is opaque. We do not have good data on how many loans are troubled, but anecdotal evidence suggests problems are building. Private equity funds cannot exit investments through sales or IPOs because markets are weak. They are stuck holding companies longer than planned, which stresses fund returns. If private equity and private credit start having serious problems, it affects institutional investors. Pension funds, endowments, insurance companies have allocated heavily to these strategies. If they take losses, it affects their ability to meet obligations. It also affects banks that provide credit lines to private equity funds. The interconnections spread the stress. The third crack is in leveraged loans and collateralized loan obligations, CLOs. This is a $2 trillion market that most people have never heard of. Companies borrow money through leveraged loans, which are syndicated and sold to institutional investors. These loans are then packaged into CLOs, similar to how mortgages were packaged into mortgage-backed securities before 2008. CLOs have been viewed as safe because they have not had major losses, even in past recessions. But that is because we have not had a real stress test with high interest rates and recession at the same time. Leveraged loan borrowers are typically lower quality companies. They are the most vulnerable to economic slowdown and higher rates. Default rates on leveraged loans have been creeping up. If they rise significantly, CLO investors will take losses. Banks and insurance companies hold a lot of CLOs. This becomes another channel for stress to spread. The fourth crack is in emerging market debt. When the U.S. raises interest rates, it creates pressure on emerging markets. Their currencies weaken, their debt costs rise because much of it is dollar denominated. Capital flows out of emerging markets back to the U.S. seeking higher yields. We have already seen stress in countries like Turkey, Argentina, Pakistan, Egypt. If emerging market crises accelerate, it affects global banks that lend to those countries. It affects commodity markets. It affects supply chains. What starts as a problem in a small country can spread globally. The fifth crack is in government finances, not just in the U.S. but globally. Many developed countries have debt to GDP ratios above 100%. Japan, Italy, France, UK, US. When interest rates were near zero, this was manageable. But with rates at 4 to 5%, interest costs are exploding. Governments face fiscal stress. They must cut spending or raise taxes or borrow more. All of these options slow economic growth. Slower growth means lower corporate profits, means weaker asset prices. These five cracks, commercial real estate, private equity and credit, leveraged loans and CLOs, emerging markets, and government finances, are all related. Stress in one area can trigger stress in others. This is why I worry about how fast problems could spread. We do not need all five to blow up. We just need one or two to create enough stress that confidence breaks and the cascade begins. Now, let me talk about the specific indicators I am watching to gauge how close we are to a crisis. These are the real-time data points that tell me whether the cracks are widening or stabilizing. First, I watch commercial real estate delinquency rates published monthly. I look at office, retail, and hotel separately because they have different dynamics. Delinquency rates above 5% are concerning. Above 10% is crisis territory. We are currently between 4 and 7% depending on property type, trending up, not down. Second, I monitor bank stock prices, especially regional banks. Bank stocks are forward-looking. If investors see trouble coming, bank stocks fall before the actual losses hit. I watch the KRE ETF, which tracks regional banks. It has been weak, but not collapsing. A sharp breakdown in regional bank stocks would be a red flag. Third, I watch credit spreads in various markets. The spread between corporate bonds and treasury bonds, the spread between high-yield bonds and investment-grade bonds. Widening spreads signal increasing risk perception. Spreads are moderate now, but if they spike, it indicates stress. Fourth, I follow FDIC reports on banks with significant commercial real estate exposure. The FDIC publishes lists of problem banks, though not by name. The number of problem banks has been increasing. If this accelerates, it signals brewing trouble. Fifth, I track transaction volumes and valuations in commercial real estate markets. Websites like CoStar and Real Capital Analytics publish data. Transaction volumes are down 70% in some markets. When transactions dry up, it means buyers and sellers cannot agree on prices. This is market dysfunction. Sixth, I monitor commercial mortgage-backed securities, CMBS, prices and delinquencies. CMBS are bonds backed by pools of commercial mortgages. If CMBS prices fall and delinquencies rise, it signals trouble in the underlying properties. Some CMBS tranches are trading at 60 to 70 cents on the dollar. This implies expected losses of 30 to 40%. Seventh, I watch the Fed's Senior Loan Officer Survey, published quarterly. This survey asks banks about lending standards and demand for credit. Banks have been tightening commercial real estate lending significantly. Tight credit makes it harder for properties to refinance, which accelerates defaults. Eighth, I follow insurance company investments. Insurance companies are big investors in commercial real estate debt and equity. If they start taking write-downs or if rating agencies downgrade insurers due to real estate exposure, it indicates problems spreading. As of now, these indicators are flashing yellow, not red. There is stress but not panic. Delinquencies are rising but not spiking. Banks are under pressure but not failing en masse. Credit is tightening but not frozen. We are in the early stages, but the trajectory is concerning. If these indicators deteriorate further over the next 6 to 12 months, we move from yellow to red. Now let me discuss what investors should do to protect themselves, because recognizing the risk is not enough. You need to position appropriately. My recommendations depend on the type of investor you are and what you own. If you own commercial real estate directly, you need to assess your properties honestly. Is occupancy stable? Can you refinance at current rates with positive cash flow? If the answer is no, you need a plan. Either inject capital to improve the property and attract tenants, or sell now before the market gets worse, or negotiate with your lender for an extension or modification. The worst thing you can do is nothing and hope for the best. If you are a bank depositor, especially at a regional or community bank, you need to assess your bank's health. Look at their latest financial statements. What percentage of their loan book is commercial real estate? Above 30% is high exposure. Are their capital ratios strong? Above 10% is good. Do they have a history of conservative lending? If you are nervous, spread deposits across multiple banks to stay under FDIC limits, or move to a larger, more diversified bank. If you own bank stocks, especially regional banks with commercial real estate exposure, you need to assess whether the risk-reward is favorable. Bank stocks are cheap on traditional metrics, but cheap can get cheaper if losses accelerate. I would avoid banks with high commercial real estate concentrations unless you have high conviction that they can manage through the losses. If you own REITs or real estate funds, you need to understand what they own. Office REITs are under severe pressure. Retail REITs are mixed. Some are okay, some are struggling. Industrial and residential REITs are generally healthier. Know what you own and whether it can withstand the current environment. If you are a fixed income investor, be cautious about commercial mortgage-backed securities unless you have expertise to analyze them. The risks are higher than the yields compensate for in many cases. Stick with higher quality bonds from issuers with diversified portfolios. For equity investors, the direct impact of commercial real estate problems is limited unless you own banks or REITs, but the indirect impact through credit crunch and economic slowdown could be significant. Focus on companies with strong balance sheets, low debt, and stable cash flows. Avoid highly leveraged companies that need to refinance in the next few years. For portfolio allocation, I recommend increasing defensive positioning. Hold more cash than normal. Cash gives you dry powder to buy assets when prices fall, and it gives you peace of mind during volatility. Own gold as a hedge against financial system stress. Gold does well when confidence in financial institutions weakens. Own treasury bonds for safety, though be mindful of duration risk. Own quality stocks that can withstand economic slowdown. Now let me talk about the policy response and why it matters. When the crack spreads and becomes a crisis, the government and Federal Reserve will intervene. They always do. The question is how and with what consequences. The Fed has several tools. They can cut interest rates to reduce borrowing costs and support asset prices. They have already telegraphed that they will cut rates in 2025 if needed. They can provide emergency lending to banks through the discount window or special facilities like they did in 2023. They can buy troubled assets like they did in 2008 with TARP. They can essentially backstop the system. The Treasury and FDIC can guarantee deposits beyond FDIC limits to prevent bank runs. They can arrange mergers of troubled banks with healthy banks. They can inject capital into banks if needed. They have done all of this before. Congress can pass fiscal stimulus, though this is more complicated politically. They could provide aid to commercial property owners or tenants. They could extend loan programs. They could fund infrastructure spending to boost the economy. But Congress is dysfunctional and divided, so fiscal response is less certain. The problem with these interventions is that they create moral hazard and long-term consequences. When banks and investors know they will be bailed out, they take more risk. When the government prints money to solve problems, it causes inflation and weakens the currency. When deficits explode to fund rescues, it adds to the debt burden. The interventions solve the immediate crisis but create future problems. This is why I talk about preparing for multiple scenarios. Scenario 1 is that the crack gets fixed before it spreads. The Fed cuts rates. Some banks fail, but it is contained. Commercial real estate stabilizes at lower valuations. We muddle through. This is possible, but requires things to go right. Scenario 2 is that the crack spreads into a moderate crisis. Bank failures increase, credit conditions tighten, the economy slows or enters mild recession, asset prices fall 10 to 20%. The Fed cuts rates aggressively and provides liquidity. The crisis is contained within 6 to 12 months. Damage is meaningful, but not catastrophic. Scenario 3 is that the crack spreads into a severe crisis. cascading failures across multiple parts of the financial system, credit freeze, sharp recession, asset prices fall 30 to 50%. The Fed cuts rates to zero and implements massive QE. Government deficits explode. The crisis lasts 12 to 24 months and results in significant wealth destruction. I assign probabilities. Maybe 30% to scenario 1, we muddle through, 50% to scenario 2, moderate crisis, 20% to scenario 3, severe crisis. This means I see an 80% chance of some version of crisis spreading. The severity is uncertain, but the direction seems clear. Let me share some historical parallels to give context. The commercial real estate crisis I am describing has similarities to the savings and loan crisis of the late 1980s and early 90s. Hundreds of savings and loan institutions failed due to bad real estate loans. The government created the Resolution Trust Corporation to take over failed institutions and sell assets. The crisis cost taxpayers over $100 billion, but it was contained and did not become systemic. The current situation also has elements of the 2008 financial crisis, though with important differences. In 2008, the problem was residential mortgages packaged into complex securities and held by highly leveraged financial institutions. The crisis spread globally because the securities were so widely distributed and so opaque that no one knew who had exposure. Now, the problem is commercial real estate, which is less opaque, but still involves leverage and interconnections. One key difference is that regulators are more prepared this time. They learned from 2008. They have tools and playbooks. Banks have more capital. The system is more resilient. This is why I think severe crisis is less likely than moderate crisis. But resilience is not immunity. If stress is severe enough, the system can still break. Another parallel is Japan's real estate bubble in the late 1980s. Japanese commercial real estate prices went parabolic, driven by easy credit and speculation. When the bubble burst in the early 90s, it triggered decades of economic stagnation. Banks were saddled with bad real estate loans. They became zombie banks, alive but not functioning properly. The Japanese economy never fully recovered. Could this happen in the U.S.? It is possible if we do not address the commercial real estate problem decisively. Let me close with this. Financial systems are complex and fragile. They depend on confidence and leverage. When confidence is high and leverage is used wisely, the system functions smoothly. But when cracks appear and confidence wavers, leverage amplifies problems. What starts as a small crack can spread very fast through interconnections and feedback loops. The crack I am most concerned about right now is commercial real estate. But it is not just about office buildings. It is about the banks that lent to those buildings, the investors who bought securities backed by those buildings, the pension funds and insurance companies that invested in real estate funds, the broader credit markets that depend on confidence in financial institutions. Everything connects. The crack is there. It is widening. The question is whether it gets fixed or whether it spreads. Based on the data I am seeing and the dynamics I understand, I believe the probability of spreading is high. Not certain, but high enough that preparation is essential. My message to you is this: understand the risk. Monitor the indicators I described. Position your portfolio defensively. Increase cash. Own safe haven assets. Focus on quality. Reduce exposure to vulnerable institutions and asset classes. Do not panic, but do not ignore. The financial crack could spread fast. Be ready. But let me give you much more specific detail about what is happening in different commercial real estate markets, because the situation varies dramatically by geography and property type. Understanding these nuances will help you assess your own exposure and make better decisions. Start with office buildings in major cities. San Francisco is perhaps the worst situation in the country. Office vacancy rates are over 30%. Companies like Twitter, now X, Salesforce, and others have dramatically reduced their office footprints. The shift to remote work has been permanent for many tech companies. Office buildings that were worth $1 billion in 2019 are now worth $500 million or less. Property owners are walking away. Banks are foreclosing. The city is losing tax revenue as property values fall. It is a doom loop. New York City is better than San Francisco, but still stressed. Vacancy rates are around 20%. The return to office has been stronger in finance and law than in tech, so Manhattan has more activity. But Class B and C office buildings, the older, less desirable properties, are in serious trouble. Many buildings will need to be converted to residential or torn down. This requires massive capital that owners do not have. Washington, D.C. has similar problems. Government contractors who lease office space are reducing footprints. The federal government itself is allowing more remote work. Office buildings near government offices are struggling. In contrast, some Sunbelt cities like Austin, Dallas, and Charlotte have held up better, but even these markets are seeing rising vacancy and falling rents. The key insight is that office building problems are concentrated but severe in specific markets. If you own office exposure in San Francisco, New York, or Washington, D.C., you have a serious problem. If you own office exposure in growing Sunbelt markets with strong population growth, you might be okay. Location and building quality matter enormously. Retail real estate is mixed. Shopping malls, especially older enclosed malls in declining areas, are dying. They were already struggling before COVID due to e-commerce. The pandemic accelerated the trend. Many malls are now almost empty. Banks holding mortgages on these properties will take huge losses. But retail strip centers anchored by grocery stores or essential services are mostly fine. People still need groceries and pharmacies. High-end retail in wealthy areas is also okay. It is the middle market malls that are in trouble. Industrial properties, warehouses, and distribution centers have been the star performers. E-commerce growth drove massive demand for logistics space. Amazon and other retailers needed warehouses near population centers. Industrial vacancy rates are very low. Rents have been rising. This sector is healthy. If you own industrial real estate exposure, you are probably fine. Multifamily residential, apartment buildings, is complicated. On one hand, there is structural demand for rental housing. On the other hand, rents have been falling in many markets as new supply comes online. Cities like Austin, Phoenix, and Charlotte built massive amounts of apartments in 2021 and 2022. Now there is oversupply. Add in higher interest rates, making it harder to refinance, and some apartment owners are struggling. But the fundamentals are better than office. People need housing. Hotels are recovering from COVID but face headwinds from recession risk and reduced business travel. If the economy slows, hotel occupancy will fall and owners will struggle. Hotel loans are riskier than other property types. Banks with hotel exposure need to be watched carefully. The overall picture is that commercial real estate is not monolithic. Office buildings in major cities and enclosed malls are in crisis. Industrial and well-located retail are mostly fine. Apartments and hotels are in between. This means the crack is not hitting all banks equally. Banks with high exposure to office loans in San Francisco or New York are in deep trouble. Banks with diversified portfolios weighted toward industrial and apartments are much better positioned. Let me talk about specific banks and their exposures because this is actionable information. I cannot give specific investment advice on individual banks, but I can describe the types of situations that concern me. Regional banks with $50 billion to $200 billion in assets are the highest risk. They are too big to be community banks, but too small to be nationally diversified. They tend to specialize in commercial real estate lending in their regions. If their region has office building problems, they have serious exposure. Examples include banks in the San Francisco Bay Area, New York City, Washington, D.C. Community banks under 10 billion in assets are also risky, but for different reasons. They are even more concentrated geographically. If their small market has commercial real estate problems, they have no diversification to offset it, but they also tend to know their borrowers better and may have worked out problems early. The largest banks, J.P. Morgan, Bank of America, Wells Fargo, Citi, are much safer. They are diversified across property types, geographies, and business lines. Commercial real estate is a smaller percentage of their loan books. They have fortress balance sheets. They will survive and may benefit by acquiring weaker banks. For depositors, the message is clear. If you have deposits over FDIC limits at a regional or community bank, assess their commercial real estate exposure. You can find this in their quarterly reports. If commercial real estate is over 30% of loans and they are in a stressed market, consider moving some deposits to larger banks or spreading across multiple institutions. For investors in bank stocks, the opportunity and risk depend on the specific situation. Some regional banks are trading at very low valuations, below tangible book value, which implies the market expects significant losses. If you believe the losses will be less than the market fears, there could be value, but you need to analyze the loan portfolio carefully. I generally avoid this kind of analysis unless I have strong information advantages. For most investors, avoiding the riskiest banks is wiser than trying to pick winners. Let me discuss the CLO market in more detail because this is where contagion could accelerate quickly. Collateralized loan obligations are securitizations of leveraged loans. A bank makes loans to mid-sized companies, usually private equity-owned businesses. These loans are packaged into a CLO and sold to investors in tranches. The senior tranches are rated AAA and considered very safe. The junior tranches, called equity, are riskier but offer higher returns. The CLO market has grown to over $1.6 trillion. Banks, insurance companies, pension funds, and mutual funds own CLO tranches. The attraction is that CLOs have historically had low default rates and good returns. Even during the 2008 crisis, AAA CLO tranches did not default. But the current environment is different. The underlying loans are to companies that are struggling with higher interest rates. Many are losing money or barely profitable. Private equity sponsors are not supporting struggling portfolio companies the way they did in the past because they have their own problems. Default rates on leveraged loans are rising, currently around 4%, up from 2% a year ago. If defaults reach 8 to 10%, which is possible in a recession, the junior CLO tranches will take losses. Even some senior tranches could be at risk if defaults go higher. The contagion risk is that CLO investors panic and try to sell, but CLOs are not very liquid. There is no deep secondary market. If many investors try to sell at once, prices gap down. This forces mark-to-market losses for holders. Banks and insurance companies have to take write-downs. This reduces their capital. They have to shrink their balance sheets. They reduce lending. Credit conditions tighten. The economy slows further. More companies default. More CLO losses. The spiral accelerates. I am watching CLO prices carefully. So far, they have held up reasonably well. But if AAA CLO tranches start trading below 95 cents on the dollar, it signals serious stress. Below 90 would be alarm bells. We are not there yet, but it is something that could develop quickly in a risk-off environment. Now let me talk about what policymakers should do versus what they will probably do, because understanding the gap between ideal policy and likely policy helps you position for reality. Ideally, we would allow troubled commercial real estate projects to fail. Property owners who over-levered would lose their equity. Banks that made bad loans would take losses. If banks fail, the FDIC would shut them down in an orderly manner. Healthy banks would acquire the assets at fair prices. The market would clear. This would be painful in the short term, but would set up healthy long-term growth. But this is not what will happen politically. Politicians hate bank failures. They hate headlines about financial crisis. They hate angry constituents who lose money. So they will pressure regulators to go easy on banks. They will push the Fed to cut rates aggressively to help banks refinance loans. They will provide government support to prevent failures. The Fed will probably cut rates in 2025, maybe 2 or 3 cuts, bringing rates down to 3.5 to 4%. This helps banks and property owners refinance. It reduces stress, but it also keeps zombie properties alive. It delays the necessary adjustment. It sets up bigger problems down the road. The FDIC will probably arrange mergers of troubled banks rather than outright closures. This is what they did with First Republic in 2023. JP Morgan acquired First Republic with government support. Similar deals will happen with regional banks that get into trouble. This protects depositors and maintains confidence, but it also concentrates the banking system further into the largest banks. The likely policy response is muddling through rather than decisive action. This means the crack will spread slowly rather than all at once. It means the crisis drags on for years rather than being resolved quickly. It means asset prices stay depressed for longer. It means economic growth stays sluggish. This is bad for the economy, but not catastrophic for financial markets. Assets reprice lower but do not collapse. This is the base case I am expecting. The tail risk is that policymakers lose control, that bank failures happen faster than they can respond. That confidence breaks before intervention can be effective. This happened in 2008. Lehman Brothers failed on a weekend. By Monday, the entire financial system was seizing up. The Fed had to implement unprecedented measures to prevent total collapse. A similar dynamic could happen if multiple large regional banks fail simultaneously or if there is a run on the banking system broadly. To protect against tail risk, I maintain higher cash balances than normal. Cash at the largest, safest banks. I own gold. I own treasury bonds despite their low yields. These are insurance policies. They protect against the worst outcomes. I hope I do not need them, but I am glad to have them. Let me discuss one more crack that could interact with commercial real estate to make things worse: student loans and consumer debt. Americans have over 1.7 trillion in student loans and over 1 trillion in credit card debt. With interest rates higher and inflation eroding real wages, consumers are struggling to service this debt. Delinquency rates are rising on both student loans and credit cards. If consumer stress leads to defaults, it affects banks that issue credit cards and hold student loans. It also affects the broader economy as consumers cut spending. Reduced spending means lower corporate profits, means weaker stock prices. It feeds back into the commercial real estate problem as companies cut costs and reduce office space. These feedback loops can turn a manageable situation into a severe recession. I am watching consumer credit indicators closely. Credit card delinquencies above 5% would be concerning. Student loan defaults above 10% would signal serious distress. We are not there yet, but we are seeing deterioration. The resumption of student loan payments in late 2023, after the pandemic pause, has stressed many borrowers. Let me close with very specific action steps for different types of investors. If you are a retiree living on fixed income, focus on safety. Move deposits to the largest banks. Own treasury bonds and bond funds for income. Hold meaningful cash. Own some gold. Avoid REITs and bank stocks. Your priority is capital preservation, not growth. A financial crisis could devastate a retirement portfolio. Position defensively. If you are middle-aged accumulating wealth, balance safety and opportunity. Hold 20 to 30% cash and bonds for stability. Own quality dividend stocks 40 to 50% of portfolio. Own gold 5 to 10%. Have some dry powder to buy assets if they become cheap. Avoid the riskiest parts of the financial system, but do not go entirely to cash. This is the time to be cautious but not paralyzed. If you are young with decades ahead, you can take more risk. A crisis would be painful, but you have time to recover. Continue investing regularly through dollar cost averaging. Focus on quality companies that will survive. If prices fall sharply, increase your investment rate. This is how wealth is built, by buying quality assets when they are on sale. Regardless of age, everyone should understand what they own and why. Know what banks hold your deposits. Know what REITs or funds you own. Know what exposure you have to commercial real estate, either directly or through funds. Knowledge is power, ignorance is risk. The financial crack I have described is real. It is growing. It could spread fast under the right triggers, but it is not predetermined. Actions by policymakers, by market participants, by you, can influence the outcome. The crack might get patched before it becomes a crisis, or it might spread into something significant. We do not know for certain. What we do know is that preparation is better than reaction. Understanding risk is better than ignorance. Having a plan is better than hoping. The crack exists. Monitor it, prepare for it, and position yourself to weather whatever comes. That is the best any of us can do in an uncertain world where financial cracks can spread fast.